Oh, hello and welcome to this Moneycontrol live stream. I'm Nandita Khemka and I have with me our markets editor in Mahalakshmi. And, the markets have been, in fact, knocking at record highs. They're flirting with that 18,881 levels or thereabouts, but haven't quite got there. But, the kind of bull run that we have seen, is this a structural one? Is this here to stay? Or, where are we headed from here? To discuss all that, we have a very special guest with us today, Saurabh Mukherjea, who's the founder and chief investment officer of Marcellus Investment Managers, is joining in this morning. Well, good morning, Saurabh. Good to have you on the show. We have been knocking at those record levels. Looking back, did you expect Nifty to come close to this level somewhere in this year? Or, where would you expect markets to head from here?
Look, I honestly, we don't focus so much on the index per se, Nandita. But what we expected full well through most of last year was that as and when the Fed stopped its rate hikes, we expected to see foreign investors return to India. And I think they've done so. Through last year, we could see that the amount of damage China was doing to itself, the belligerence vis-a-vis America, China's belligerence vis-a-vis America, we felt would be a trigger for a massive bull run in India. And I think that's what we are seeing so far. Foreign investors have $3.5 trillion invested in China. They have $500 billion invested in India. And as China becomes basically an enemy of the West, much of that $3.5 trillion in China is going to go back to the Western world. I think from there, it's reasonable to expect that FII investments in India will double over the next 3 to 4 years. I think without getting into too much detail, if FII investments double in the Indian market over 3 to 4 years, that cannot be anything other than a bull run in the Nifty or the Sensex.
Saurabh, good morning. We've all, got to learn that this time is different. Different are the real 4 words that are really dangerous in investing. And yet, this time it really feels like it is different because the domestic story is very strong despite the fact that we've seen such a sharp hike in rates over the past 14-15 months. In the US, if you see, and in the global markets, again, growth has been fairly strong, whether you look at GDP levels or the jobs or employment numbers. Everything looks strong despite the sharp rise in rates that we have seen. So what is really sustaining this growth, and do you see this as risk building up or something that we can still build on and rise further from here?
So I think, Mahalakshmi, let's split the current situation and the next couple of years into 2 bits. I think there are elements of this time is different. I'll come to that. But I think much of it is familiar territory. Typically, the Indian stock market rallies after about a weak growth or negative growth in America. In fact, if you look back from say 1980 onwards, we've never ever had a bull run in India without the American economy hitting a tough spot. And the reason is relatively simple. When the American economy gets into trouble, the Fed begins a rate cutting cycle. Typically 2.5 percentage points is what the Fed cuts on the way down. And when the American economy gets into trouble, the price of crude typically halves, which is roughly a 3 to 4% GDP boost to India, right? So from the early 80s, the early 90s, post 9/11, post Lehman, post COVID, right? Whenever America gets into trouble, that's typically the signal for a sustained bull market in India. And I think this time is very similar in that regard, right? It's a repetitive cycle. It never fails. America gets into trouble. American banks blew up Jan, Feb, March this year. American banks blew up. You can almost time it to that. If you want to, for those who are out there and love market timing, I'm not one of those, but those who love market timing, America gets into trouble. You know that with a small lag, India will start doing well. Where this time is different is I have never in my 20 years, I've never seen a situation where you've hiked rates in India by 2.5% and the country's economy is running at 7%. Or indeed, you have hiked rates in America by 5%, right? It's the steepest rate hike since the 1970s. You've hiked rates in America by 5%, and yet America is running at full employment. Stock market near record highs, both in America and India. That is quite remarkable. Honestly, this bit is stunning to watch. Heavy rate hikes over the last 18 months, and yet the Indian economy is in cruise control. Stock market near record highs. And I think that's why I reckon the next 2 to 3 years will be a stellar bull run. If the economy after rate hikes can hold up so well, imagine what will happen as over the next couple of years rates start drifting downwards.
So, Saurabh, what you talked about is really about economic growth, right? But if you look at markets, it's not very different. I mean, US markets and Indian markets have in the past at least been highly correlated. So, in that sense, right now, how do you see the trajectory for the US economy? And structurally, in India, if you see, everything seems to be in our favor. The geopolitics seems to be in our favor. The energy basket that is changing is in our favor. This China plus one sentiment, the fact that the government is pushing towards more and more exports, that piece is again, playing in our favor. The fact that banks, corporate balance sheets, that story is now the steady flows that we are seeing in SIPs, all of that, that piece is looking very good for India. Does this change the global cues that you're getting? Does that change or the complexion in any way, or can we really decouple from US markets from here on?
So let's look at it again in two parts. Let's break the economy into the real economy and then the stock market. On the real economy side, both talking to people in America and say visiting Chennai and visiting say the area around Bangalore, the Hosur Bangalore belt, it's relatively clear that we've got major trade flow changes underway, right? So smartphones, which is roughly a $400 billion global industry, medical devices and healthcare equipment, roughly a $300 billion global industry, APIs and pharmaceuticals, $300 billion industry. In total, a $1 trillion worth of industries, right? China is the dominant force today in smartphones, in medical devices, in pharma. China makes 60-70% of the global production. India makes less than 10%, right? We are barely at 100 billion, they're at 900 billion. I reckon this flow is shifting. You can see that. You can see that in, say, the commentary Divi's Lab is giving. We can see that when we speak to Divi's Lab's customers in America. Divi's is the world's 5th largest API manufacturer, big Marcellus holding. I'm personally invested in it through Marcellus, so are my parents. So the world's 5th largest API manufacturer, India's largest. We can see how materially the outlook is changing for them. In contrast, Wuxi, China's largest API manufacturer. We are hearing from Wuxi's clients that the US government is reluctant for the American drug majors to give more business to Wuxi, right? So big shifts in pharma. China dominates API production. India has only 10%. And we can see from our discussions with API manufacturers that major changes on the afoot there. Coming to mobile phones, Tim Cook has already said 25% of iPhones or Apple's production could be moved to India in the next 3-4 years. If you go to Bangalore, you will see the efforts on the ground, whole ecosystem coming up around Bangalore. Remember, Apple makes $220 billion of kit every year. So if 25%, $50-60 billion coming to India, that's a massive deal. India barely makes 5-6 billion of smartphones today. So 10-fold growth in India's smartphone production in the next 3-4 years. And finally, medical devices. We make a couple of $1 billion of it. China makes $200 billion of it. Again, very similar to pharma. America wants lower dependence on China for medical devices, and again, a big industry coming up. So I reckon in terms of this China plus one business, we will add conservatively, we'll add around $100 billion to our GDP over the next 3 years as the world shifts flows. Honestly, 100 billion is a super conservative figure. If the reality could be 2x, 3x this number. And even then, China will account for 70% of the global production of these items. Now, the analogous piece on that is money flows, right? So when I visited America 2 weeks ago, I have never seen this sort of panic in the institutional investor community. They are under severe pressure, both from their clients and from the US government, to get money out of China ASAP, and they're under severe pressure to invest in India fairly urgently. The quantum of money deployed in China is so colossal that even if FIIs put in $100 billion a year in India for the next 5 years, even then, they would have just pulled out 1/7 of their investments in China. So the world is changing. These are seismic shifts. These will probably come once in our lifetime. And I think we all will now enjoy the privilege of living in the most populated country in the planet as it goes through a seismic shift in its global standing.
Right. Sorry, two questions related to what you said, Saurabh. One is that, the pharma pie is really looking good. As you pointed out, the API story is looking very good. The overall basket that we covered in the China Plus One, including manufacturing, looks very good. But none of this is really hugely represented in the index, especially the Nifty. So do you see this part becoming a disproportionate share or seeing disproportionate share in the index over the next 3 to 5 years, and therefore the focus for retail investors or institutional investors has to be disproportionately focused on this area? Second question is the fact that we are in this, inflection point where we are almost at a point where we can set our own trajectory. Should we stop bothering about or anchoring against the valuation benchmark set in the past?
Okay, so let's take the first point. On representation in the stock market, we have a reasonably evolved specialty chemicals and API manufacturing set listed in the stock market, right? So if I look at our own small and mid-cap portfolios, little champs and rising giants, we have Divi's Lab, which we discussed. We have GMM Pfaudler, which makes the ceramic reactors in which almost 70-80% of the world's specialty chemicals and pharma are made. We have alkyl amines, which supplies aliphatic amines to the space. We have Porsche, which makes phosgene. So we ourselves have reasonably good investments. I think many more IPOs will come. Mahalakshmi, from what I can see, specialty chemical manufacturers in the Baroda, Surat, Vapi belt and around the Hyderabad belt. There's a fair few coming towards the stock market, and investors like us are looking forward to seeing if these guys are well-run, cash-generative businesses. I think there's a boom underway. There's reasonable representation in the market. We are invested in Divi's. We are not invested in Laurus, but I suspect Laurus will also get plenty of business out of this. And certainly my friends in private equity are making a beeline for investments in API, and I'm pretty sure 5 years hence, those PE investments will come to the stock market. Coming to electronic manufacturing services, there's already a fair few listed, right? There's, I think, Amber listed, Dixon's listed, Keynes listed, Data Matters, and from what I can see, many more IPOs are underway. I think the whole belt around Chennai and Hosur, Chennai and Bangalore, there'll be, by the end of this fiscal, I suspect there'll be at least a dozen listed plays in electronic manufacturing services, making phones, electric toothbrushes, TVs, air conditioners, and so on. Colossal industry underway there. The only piece which is not listed is healthcare equipment. And that might take a while coming, because I think the healthcare equipment gestation, the complexity of the products, the intellectual property issues are probably a little deeper. That might take 2-3 years for those guys to come to the market. But already on chemicals, pharma, and electronic manufacturing, the revolution is underway, reasonable amount listed, and many more listings en route to the stock market. Coming to valuations, right? The area where I think you and I have discussed this on previous Moneycontrol shows, and I suspect I'll discuss this till my retirement day. The area where we sort of diverge from the prevailing view in India is look for sasta, look for cheap on PE or PB. Our view is slightly different. Our view is look for companies which can grow at 20%, which can grow free cash flows at 20% for say 15-20 years, right? If you do a basic DCF analysis, companies that can grow free cash flows at 20% for 15-20 years, example Divi's, companies who can do that are worth well in excess of 100 P. The stock market rarely gives them that valuation, and hence you can get companies like Divi's at heavy discounts to fair value. And when you get that, as we did last year, when you get that, you buy as much as you can. Through November, December, January, we trebled our investment in Divi's Lab because the discount to fair value was massive. So this point of view, right, look for companies that can grow for 15-20 years at 20% growth in free cash flows. This will remain Marcelitz's signature style. And we are so glad that we live in a country which gives us companies of this quality at massive discounts to fair value. And people out there, this is a listed company, it's been listed for 20 years. If you open the accounts, you'll see the trajectory in its ROC over 20 years. And you'll see a promoter who's gradually built what is now the world's 5th largest API manufacturer. I think a company which a decade hence potentially will be in the global top 3.
Right, Saurabh, we've spoken about specialty chemicals, pharma and the likes. Let's talk about IT. Would you take a contrarian bet when it comes to the IT biggies like TCS and Infosys? And also, I want to also talk about the AI wave that, has come about. We've seen the likes of NVIDIA breaking records. Do you think investors have really missed the bus when it comes to some of these stocks? how should one ride the AI wave, and how would it benefit Indian IT? Largely, what should the portfolio construct look like when it comes to the IT stocks?
So I don't think there's any wave to be written. We are living in the middle of a tech revolution. So it's just like timing the steam engine cycle in the middle of the industrial revolution would have been a daft idea. Anybody out there who's trying to time IT stocks, I think you're welcome to try, but I'm not going to do that. We are heavily invested in TCS. Again, it's in Marcellus's portfolios. I'm invested in those. My parents are invested in those, as are 9,000 clients. They're heavily invested in TCS in our large cap portfolio, and we are invested in Tata Elxsi and LTTS in our mid cap portfolios. In some of our advisory clients, we've advised them that they should buy Infosys. The reasoning is straightforward. The order book wins, the deal wins of these companies continue to be punching through record highs each year, including the last 3 months, where supposedly America is in a slowdown. In spite of the slowdown, TCS announced record deal wins. So did Tata Elxsi. So did LTTS. And if you add to that two things, firstly, firms like Accenture are saying that only 70% of the migration to cloud is done. That only 30% is done. 70% of Fortune 500 companies are yet to make the jump to cloud, right? Which means there's plenty of work to be done as and when American companies press the green signal on more tech spending. Secondly, as you're rightly saying, AI makes it imperative that companies move to cloud. You cannot benefit from generative AI as a corporate if you don't move your kit to cloud. Therefore, generative AI becomes a catalyst which will push global majors to give more business to the Indian vendors for cloud migration. In our global compounders portfolio, we've got as plays on generative AI and plays on the tech revolution. We have Apple in there. We have high hopes for the new goggles that they're going to launch in a month or so. Apple's own generative AI products, we reckon, will be a transformation in consumer entertainment. We have TSMC, which makes the chips, whether it's Nvidia's chips or Apple's chips or Samsung's chips, it's all made in TSMC, Taiwan Semiconductor. And we have ASML. ASML is the company which does lithography in all the chips that you and I use, right? Whether it is Nvidia's chips or Intel's chips, the lithography, the etching on those chips comes from this one Dutch company, probably the most important company you've never heard of. So through our global compounders portfolio, we're playing the hardware piece of the tech revolution. Through our Indian investments in our Indian portfolios in TCS, LTTS, and Tata Elxsi, we're playing the software and operating expenses side of this. But anybody out there who's trying to time the tech cycle, best of luck to you. We are not interested in timing it. We're living in the middle of the tech revolution. And I think these companies will carry on making huge amounts of money for our clients for many years to come.
Saurabh, one related question. I mean, of course, you seem to be fairly positive on the IT sector. But last quarter, I mean, if you look at the analyst community, almost nobody was predicting that there will be a slowdown, rightly so, because you were not seeing that narrative getting built up in the US also. But Infi was a huge, unpleasant surprise. Now, how would you view, as you approach the quarterly results this time, what is your take? Could there be temporary blips or unpleasant surprises like Infi posted last time in a few more companies, or would you see last quarter as an aberration?
So Mahalakshmi, honestly, I don't lose too much sleep on quarter-to-quarter results. We own TCS in large amounts in our flagship portfolio, as I said. And if I look at TCS's results last quarter, and for reasons I don't fully understand, some people had issues with TCS results. I was delighted by TCS's results. I think they announced some of their largest deal wins ever. Their operating margins were close to the 25% mark. Their attrition had come off substantially. They anyway have the lowest attrition in the sector. Their attrition had come off substantially. TCS has had. In terms of EPS compounding, they were clocking in around the 15% mark in rupee EPS compounding. And as everybody knows, they've given, I think, the best part of 50,000 crore dividend. Now tell me, who in their right mind has a problem with these sorts of results? 25% op margin, 15% EPS compounding, billions of dollars of deal wins. dividend payout best part of 50,000 crores, and a company which has done this consistently for 20 years. Now let's look ahead, right? These consultancy companies such as IDC, who specialize in giving IT services growth forecast, the growth forecast for this year, 2023, is as higher than it was for 2020, 4.2% dollar revenue growth rather than 3.9%, which was the outturn. 3.9 was the actual number for 2022. 3.4 was the 2021 number. So 3.4 2021, 3.9 2022, 4.2 current year, 4.2 next year. Where is the slowdown in that? I fail to see. And that's why when people, jump up and down on quarterly results without having a sense of perspective, I believe it's a great opportunity for sensible investors to make money.
Right, Saurabh, I want to get in your thoughts on Page Industries as well. The stock has been underperforming. Earnings weren't really all that great this time around. But do you think this underperformance would reverse course in some time going forward? How should one approach Page Industries now?
So we've been large shareholders for 5 years, a little over 5 years actually. And we've seen them go through this before. So I remember in the 1.5 years running to the summer of 2019, the stock halved in the 1.5 years running to the summer of 2019. And the stock halved because revenue growth was basically non-existent for 1.5 years, right? Obviously, through COVID, their loungewear piece was a spectacular performer. And the loungewear piece naturally stagnates post-COVID because we're sitting in office no longer wearing t-shirts and shorts. We're sitting in office wearing shirts and trousers. So the loungewear piece is broadly back to where we think will be a post-COVID normal for them. So they've doubled revenues in loungewear pre-COVID to post-COVID, but that's because they've doubled the retail footprint, the distribution footprint of this franchise. So we are confident that the loungewear piece has no more further to go down. What they are going through, we are happy that they're going through, is they're changing the way they retail the product. They're putting in more technology in the retailer level. They're putting in more technology at the distributor level. And as they've said over the last 6 months or so, as they put more tech into the channel, the inventory in the channel comes off. The inventory is off by a month or so, which is a great thing. Remember, if the inventory comes down, the distributor's return on capital doubles, right? The inventories come down by a month. Distributor's return on capital has doubled. If you adjust for that reduction in inventory, the business is holding up nicely. We're trying to gauge how much further the inventory correction will continue. My reckoning is we are bulk of the way through the inventory correction. We might have another couple of quarters. That means the June quarter and the September quarter. We might have another couple of soft quarters as the inventory corrects further. The more the inventory corrects, the better it is for the distributor in the long run, the better it is for the franchise. And if the stock comes off like Divi's came off last year, we will try to use that as an opportunity as well, right? So these adjustments where smart companies make good adjustments to their channel, but in the short run, it looks like there is pain in the channel because the inventory is coming down. We think these are good adjustments. The rise of technology in Indian retail distribution is a positive thing. And if the stock market interprets that the wrong way, we'll try to capitalize on that opportunity. So we are happy with what they are doing, although we realize that this could be another couple of quarters of soft results as the inventory destocking at the distributor level continues.
Saurabh, what is your take on some of the new tech companies, especially Zomato, Nykaa, PB Fintech? Of course, there is a resurgence in some of these stocks and investors. A lot of institutional investor buying is also coming in some of these counters. Do you see them as coming to a stage where they have clear moats and they can actually reap the benefits of that in future, especially because you don't pay, I won't say you don't pay attention to valuation, but that is only, second, third criteria. And the moat is really the primary criteria for you to buy.
So I'll answer this question. If you don't mind, I'll then run off. Of the new lot of tech companies that went public, we think Nykaa is the most moated of the lot, and in their BPC platform, we're not quite so sure why they're trying to build out an apparel platform. Doesn't logically stack up with us. But the BPC platform, all credit to Falguni Nair and team, they've done a really good job there. We wish that they'd ramp up on the tech piece there. So at the moment, say you and I shop separately on the BPC platform, it doesn't seem to recognize that Mahalakshmi is a woman and Saurabh is a man. And those sorts of basic tech upgrades we wish the Nykaa platform would expedite sooner rather than later. We haven't invested yet. We're watching it carefully. We're watching to see how the team allocates capital as it starts generating a little bit of free cash flow, as the platform starts making a bit of money. We'll watch carefully as to how they allocate capital. And if we see them doing strategically the right things, we might at some stage think about investing. Beyond Nykaa, very little there out there in the new tech space in the listed world, Mahalakshmi, which is impressing us. So we'll carry on doing some more work here, and hopefully the management team will do the right thing in terms of capital allocation and business strategy.
How about Zomato and PB Fintech? I mean, Zomato, again, there seems to be a lot of optimism, the fact that they have established leadership in food delivery. Does that excite you at all?
Not really. We've looked at it, not particularly convinced. Yeah, I need to go now. Thank you very much.
All right, Saurabh. Thanks a lot for taking our time and joining in this morning. Well, with that, it's a wrap on this Moneycontrol live session. Thanks a lot for tuning in. Stay tuned to Moneycontrol for all your other news and updates.